If you have been waiting all year for mortgage relief, I need you to sit down for this one. Because on the 10th of June, the ground quietly shifted under your feet. The Bank of Canada did exactly what most of the country expected. It held. It kept the policy rate parked at 2.25%. And for a few hours, homeowners across the country exhaled. The pause was on. No pain, no hike, business as usual. And then a single, ugly number landed on the table, and it turned that quiet relief into something a lot closer to alarm. Because here is the truth that got buried under the headlines. For the first time in this entire cycle, a rate hike, an actual increase, is back on the table in Canada. Not a cut, a hike. And if you are one of the roughly 1 million Canadians renewing your mortgage in 2026, this is the video you cannot afford to scroll past. Let's start with what actually happened on the 10th of June. The Bank of Canada held its policy rate at 2.25%. That is the fifth straight decision to stay put. 5 meetings in a row where the bank has looked at the economy, looked at the risks, and decided to do absolutely nothing. For borrowers, that means prime at the major banks stayed exactly where it has been sitting, 4.45%. Now, on paper, a hold is boring. A hold is supposed to be the calm in the storm. If you are on a variable rate mortgage, nothing on your statement changed this month. If you are shopping for a fixed rate, nothing moved overnight. But that is exactly the trap. Because the story is never in the number the bank chose. The story is in why they chose it, and what they are terrified of doing next. And that brings us to the number that ruined the party. The May Consumer Price Index came in at 3.2%. Let that sink in for a second. 3.2%. That is the hottest inflation reading Canada has seen since September 2023. After months of this country being told that inflation was tamed, beaten, filed away as a problem from the past, it came roaring back into the headline. So what happened? In one word, oil. Global oil prices have climbed sharply, driven by conflict and instability overseas. And that increase does not stay politely at the gas pump. It bleeds into everything. It raises the cost of moving goods across the country. It raises the cost of getting food onto the shelves at Loblaws. When it costs more to fuel the truck, it costs more to fill your cart. And suddenly, the family that thought the worst was over is watching their grocery bill climb all over again. For the Bank of Canada, this is the nightmare scenario, because you cannot fix an oil shock with interest rates. Raising rates does not put more oil in the ground. But, and this is the part that matters, the bank is petrified that these temporary price spikes will get baked into the psychology of the economy. That businesses start raising prices just because, that workers start demanding bigger raises to keep up. That is how a one-off shock turns into permanent inflation. And that is precisely the fear that is now driving everything. Now, here is where the smart money comes in, and here is where things get serious for your mortgage. The bond market is where the professionals place their bets on what interest rates will do next. And just a few weeks ago, that market was comfortable. It was pricing in a summer rate cut. The consensus was simple. The economy is soft, so the bank will eventually ease, and relief is coming. That consensus has evaporated. The bond market is no longer pricing in a summer cut. It has changed its mind entirely. And in its place, something new has appeared. Something we have not seen in this entire cycle. The market is now pricing in a small, but very real, chance of a rate hike. Read that again. The smart money has gone from betting on relief to bracing for pain. And when the bond market moves, it does not wait for the Bank of Canada to catch up. Fixed mortgage rates take their cues from those bond yields. So the very floor that homeowners were standing on, the assumption that the only direction left was down, has been quietly pulled away. And this is where it stops being theory and becomes a very personal gamble. Roughly 1 million Canadians are set to renew their mortgages in 2026, and a huge number of them made a specific bet over the last couple of years. When rates were high and painful, they did not lock into a long 5-year fixed. Instead, they went variable, or they took a short-term fixed, a 1-year or a 2-year, deliberately keeping their options open. Let's be crystal clear about the difference, because right now, it is everything. A fixed rate locks your payment for the whole term. You are protected if rates rise, but you are also locked out if they fall. A variable rate floats with prime. You win when rates drop, and you bleed when they climb. For the last 2 years, the crowd piled into variable and short-term fixed for one reason and one reason only. They were betting on falling. That bet is now under review. The logic was seductive, and honestly, it was reasonable at the time. Why lock in at a high rate for 5 years when the cuts are coming? I'll stay flexible, ride the rates down, and renew into something cheaper. It was a bet on the cuts, and those cuts have not arrived. Worse than that, the cuts are now in doubt, and a hike has entered the conversation. So an entire cohort of Canadian homeowners is walking toward a renewal cliff, holding a bet that the market is quietly turning against. And nowhere is that bet more concentrated than in the GTA. In the Greater Toronto Area, where the average mortgage balance is enormous, even a small move in prime does not translate into small money. It translates into hundreds of dollars a month, real cash, out the door, every single month. A family that stretched to buy in 2021 or 2022 and went variable just to make the numbers work on paper is now staring at a renewal where the math no longer forgives them. If prime does not fall, or worse, if it rises, that cheaper renewal they were counting on simply does not exist. And do not count on a windfall to bail you out. For most households, the refund check from the CRA that used to feel like a little bonus is already spoken for, swallowed whole by the same fuel and grocery costs the bank is fighting, which brings every single one of us to one date, one line in the sand, the 15th of July. That is the Bank of Canada's next decision, and it has become a genuine high noon moment for the Canadian economy, because the bank is now trapped between two impossible choices, and both of them hurt. On one side, you have inflation, 3.2%, and climbing, threatening to become entrenched. The textbook says the bank must show strength, hold firm, maybe even hike, to prove it will not let inflation off the leash, kill inflation before it takes hold. But on the other side, you have the consumer. The Canadian household is exhausted. Debt loads are heavy, the economy is soft, and the job market is fragile. Raising rates into that kind of weakness risks pushing families and the whole economy over the edge. Crush inflation, and you might crush the consumer right along with it. That is the squeeze. Kill inflation or kill the consumer, and there is no clean way out of it. Every option on the table on the 15th of July costs somebody something. The bank knows it, and that is exactly why a hike, a word that was unthinkable a few months ago, is now sitting right there on the table. So where does that leave you? Here is the uncomfortable lesson underneath all of this. Wealth in this country is not just about what you earn. It never has been. Wealth is about how you manage the volatility of your debt. It is about not being the person who gets caught on the wrong side of a rate move you assumed would never come. For years, the smart play felt like wait and see, stay flexible, stay variable, don't lock in, let the cuts come to you. That strategy just got a lot more expensive, because wait and see only works when the trend is your friend. And on the 10th of June, the trend stopped being your friend. The bank held, but it held with its finger hovering over a button nobody thought it would ever have to press again. The relief was real. It just didn't last. And the smartest thing you can do between now and the 15th of July is stop assuming the next move is down and start planning for the very real possibility that it isn't. If you learned something, make sure to like and hit subscribe. See you in the next one.